Hey everyone, it's William here from Quant Data, and in this video today we're going to be showcasing exposure by strike, how we use it, and why I personally prefer it over the heat map. So this is exposure by strike. Now what it shows is the exposures of each strike price across the options chain in a cumulative view. It tells us which strikes have high and low activity of whichever exposure we have it set to view. Now there are 4 exposures that we can currently view: gamma, delta, charm, and vanna. In this example, I'm bringing you to gamma on November 20th, and I want to show you how this tool works and how it behaves over time as the trade day progresses. You can see up here on the top left that I've changed the expirations to 0 DTE, November 20th. Now, as a trader participating for the intraday session, I find it absolutely crucial to pinpoint exact data metrics. This is why I have it set for 0 DTEs, because I'm looking to buy and sell something today. I wouldn't be looking for exposures, let's say 90 days out. For example, if I'm not interested in trading something and holding it for the next 90 days. Of course, if you're looking for a longer time frame trade, you are absolutely welcome to change these exposures. Actually, it's preferred that you change these exposures to the date of the expiries that you are looking to trade. Now, on the top right here, you can also filter for more things, for example. Now, if you wanted to just look for the expiries of the next 30 days, the 90 days, you can absolutely change these filters to whatever it is that you want to change it to. Now, the name of the trading game is to look for obvious clues that the market is likely going in which direction. And on this day, we could actually see that the market attempted to make a move up twice before it finally collapsed and gave up and started to flush a significant amount in the market. And with our exposures by strike tool, we were actually able to determine at which point the market was actually going to flush based on the exposures of how they were changing. Around this point right here, I want to show you at what time things flipped, and it's actually quite eye-opening if you were to pay attention to just exposure by strike. So I'm going to bring you to 7:59 a.m. right, 7:50, 7:58. Looking still bullish. 6,800 is still the likely target, and then as soon as we hit 8:01, something changes, right? So in 1 minute, 2 minutes, 1 minute, things change drastically. So this is 8. Now 8:01, we flip bias, and all of a sudden the market became super short, 6,700. If I show you this on delta side, it's actually even more visible, right? Just the dramatic change was way more obvious. Now that's 8:01, 8 a.m. It was actually still positive, and it was positive by over 1 billion. Again, let me show you one more time. Flip 1 minute, and this was the change that we needed to see for the market for us to determine that the market was actually going to flush. And we could very easily see this with the exposure by strike tool. Utilizing our other tools that we have in Quant Data, like net drift, you would be able to tack on to the fact that the market was actually selling all their calls and loading up on long puts, and that further gave us the idea that, okay, the market is actually going to take a nosedive here. And this is the net drift tool that I'm talking about. At this point right here, the divergence between calls and puts was well over 1.5 million. And you can see just how much puts were long from that point and how much calls were being sold off from that point. So a common term we use here in Quant Data is the MVC. This is a term we tie directly with the exposure that holds the most gamma, basically the highest candle, and it stands for the most valuable contract. When it is a directional target, those strikes based on options Greeks are set to increase the most by premium if they became in the money. Of course, it is going to be up to you as a trader to determine whether the scenario calls for that contract to become in the money and whether the scenario doesn't call for that contract to become in the money. Now, why I prefer this view of exposure by strike versus the heat map is a few things. First of all, it's much easier to visualize, especially on a short time frame, being that we can filter and easily use the height of each candle as a reference for strength and weakness. Over on the heat map, there's a little bit too much information going on, so I'll show you really quickly. This is what the heat map looks like. There's just a lot more information to go on. It's not easily identifiable which contract has, for example, the highest exposures, and which contracts are losing value as time goes on. With the exposure by strike, I can tell just by the height of the candles what's changing. So let me zoom this further out for you. You can see at which point in time the market just went entirely short gamma based on the time and the candles, and how I can just kind of scroll the time series, and it's just a lot easier to view. And especially being the fact that, you know, in trading, split second decisions matter a lot, and when something like gamma exposure can flip quickly, it's much more advantageous for us to be able to identify as quickly as possible what's changed in the data profile. If you guys enjoyed that video, if you guys like that one, please like, comment, and subscribe, and we'll be putting out more content just like this one. Thanks, everyone.